Hi, this is Matthew Cratter from Trader University, and today I want to talk about what's often called Japanification. And by this, people refer to sort of the lost series of decades that Japan has experienced since the bursting of their stock market. And so a lot of people were asking me in the wake of my video about the Dow going to 100,000, could something similar happen in the US that happened to Japan over the last 30 years? If you're worried about this financial crisis, or you just want to see how to make money in both bull and bear markets, be sure to hit that subscribe button. So my basic argument in the Dow 100,000 video was that the Federal Reserve, the US central bank, can basically print as much money as they want. And they need to be able to do it in order to buy stocks, to buy bonds, especially treasuries. Eventually, now they're buying junk bonds and munis, but eventually to also buy stocks, as the Bank of Japan has been doing over the past few years. And the reason the Fed will want to do this is just because so much of the US economy is geared to the stock market. So my argument was they could basically print a lot of new money, devalue the US dollar, and thus drive the Dow, which is currently around 23,000, drive it all the way up to 100,000. Now this would be new all-time highs in the Dow, but it would not be an increase in real purchasing power. So in real terms, if you invested in a basket of stocks, a stock index like the Dow or the S&P 500, you'd be losing money holding it. Your actual purchasing power, if you used that stock, if you sold the stock and used it to try to buy food or a car or something like that, it would not buy as much as it would before. So basically the idea is central bank drives up stocks by devaluing the currency that underlies it. And this is a point a lot of people don't realize, is that a central bank can always make their stock market go up in terms of their local currency. So what happened in Japan? What went wrong in Japan? So Japanification refers to this constellation of things like slow economic growth, low inflation, low interest rates, a lot of central bank money printing in an effort to prop up asset prices. And basically, it's an economy that's sort of teetering on the edge of deflation and is never able to get out of that. So Japan tried something similar with quantitative easing, which is just when the central bank prints a lot of money, uses it to buy stocks and bonds. But what went wrong? Well, in order to answer this question, we're going to take a brief tour through the history of Japan's economy and their stock market. So the really big event that most people start with was the Plaza Accord. And this was an agreement that took place in New York City. France, West Germany, Germany was still divided back then, Japan, the United States, and the United Kingdom all met, and they decided that the US dollar had become too strong. Paul Volcker had raised interest rates a lot in the end of the 1970s, beginning of the 1980s. He sort of broke the back of inflation, but in the process, because the US had such high interest rates, it made the US dollar very, very strong. And so it was decided at this Plaza Accord, at this meeting, that they would devalue the dollar versus both the Deutschmark and the Japanese yen. And they would do this by intervening in the currency markets. Now, as you can imagine, this worked. Here's a chart of the Japanese yen versus the US dollar. And we can see that in 1985, the exchange rate was around 250. And over the next couple of years, they managed to drive down the value of the US dollar, increase the value of the yen. In other words, if you were holding yen, all of a sudden you had a lot more purchasing power. And what did the Japanese do with that purchasing power? Well, they decided to buy up a lot of the US. And I remember in the 80s, there was a lot of worries about this. I remember my uncle telling me that I should study Japanese in college because pretty soon Japan would control the entire world, and it would be Japanese would replace English. So Japan started buying up a lot of real estate, especially high-profile real estate in the U.S. They bought the Biltmore Hotel in Los Angeles. Sony bought Columbia Pictures. And this was the first time that we'd really seen a foreign economy come into the U.S. economy and sort of take down these institutions. And so there's quite a bit of anxiety around that. And it sort of culminated in 1989 when a Japanese company came in and bought the Rockefeller Center in New York City. So here's a chart of the Japanese stock market, the Nikkei 225, and we can see that it basically peaked at the end of 1989, fell off a cliff, and if we scroll out, we can see that at least in yen terms, this has never recovered. So still 30 years later, we're still below that peak, that 1989 peak, in spite of all the central bank printing, etc., etc. Now, Japanese property prices also peaked at the same time. Here's residential property prices for Japan. We can see they peaked a little bit after the Nikkei. They peaked about a year later in the fourth quarter of 1990, first quarter of 1991, and they've never recovered to their peak highs. And at one point, this is a statistic people always throw out, which is pretty interesting. Real estate in Japan became so expensive that in 1989, the land underneath the Imperial Palace in Tokyo, its paper value, if you look at real estate, was trading for $139,000 a square foot, which was 350 times the price of equivalent properties in New York City, in Manhattan. But the value of the land, just the land under the Imperial Palace in Tokyo, was worth more than the entire real estate value of all the land in California, all the houses in California. So this gives you an idea of the sort of bubble that Japan was experiencing. So what happened? Beginning of 1989, the Japanese central bank, the Bank of Japan, began to raise interest rates. These are the 3-month T-bills, but these show basically the short-term interest rates. They raised interest rates. They popped the equity market bubble. They popped the property market bubble. And they kept raising even as the market was crashing. So they reached their peak in rates in 1991. We can see in 1991, the stock market had already crashed quite a bit. So they were raising rates in the face of a declining property market and a declining stock market. And then you can see that in the early 2000s, they got down basically to zero at short-term rates. And I believe they were the first country actually to go negative as well, have negative interest rates, even before Europe. It looks like Japan went negative in 2015. Negative interest rates are where you basically you pay someone to take your money. Rather than earning interest, you pay interest. Japanese government bonds, they're called the JGBs. They've also, you can see that their yields peaked around 8% in 1990 when the Bank of Japan was finished raising interest rates, and they've been on a slow decline ever since. They spent the early 2000s at 1 or 2%, which was extremely low back then. They went negative also in 2016. So this is sort of classic Japanification, low interest rates, low bond yields all across the curve. Now, the Bank of Japan is believed to have been the first to use quantitative easing. They started it in 2001, so during the kind of global bear market of 2000 to 2002. They weren't doing very much at first, but it really got started, the real quantitative easing got started after the election of Shinzo Abe, so-called Abenomics, Abe economics. So he began what he called the 3 arrows when he was elected Prime Minister of Japan in December of 2012. These were monetary easing, fiscal stimulus, running fiscal deficits, and structural reforms. So what did this involve? Well, the biggest thing it involved was the Bank of Japan growing their balance sheet. This is the central bank. It's their equivalent of the Fed. And the way they grew their balance sheet is they printed new yen, they printed money, and they used it to buy JGBs, to buy government bonds. And we can see that it really took off after the election of Abe in late 2012. And the bank grew the central bank grew their balance sheet from, call it 1.5, I'm a little unsure about the units here, it's 100 million yen. There are a lot of zeros here, but we'll just say 1.5 all the way up to 6.19. So just an enormous expansion of the central bank balance sheet. At this point, their balance sheet of the central bank, I believe, is above Japanese GDP. And so what did this do? Well, basically they're printing a lot of money. It drove down the value of the yen. So this is the yen as it trades against a basket of foreign currencies. We can see that since 2012, since the end of 2012, this has gone from about 101. This isn't US dollar, Japanese yen. This is a basket. But the exchange rate has basically plummeted from, call it 100 down to 78 is the last reading on this. So they devalue their currency against all the other paper fiat currencies in the world. In addition to buying JGBs, government bonds, they also began to buy stocks. They're buying stock ETFs. And at this point now, the Japanese central bank, the Bank of Japan, owns nearly 50% of all the government bonds. Just a totally weird situation. But what did this do to the Nikkei? Well, we can see that the Nikkei bottomed in 2012, going into the election of Abe, and then it had a very nice rally from 2012 really until the end of 2018. We went from about, call it 9,500, roughly 9,400, all the way up to 24,000 on the Nikkei 225. So an enormous, actually quite a large rise, almost a tripling. But this only happened in yen terms. They were able to make the Nikkei go up in yen terms. But if we look at what the yen did versus the dollar, for example, at that point, it bottomed. The yen strength bottomed in around the election of Abe, and then the yen weakened quite sharply. So the US dollar strengthened against the yen. So even though it looked like the stock market was going up, it was not going up in real terms. It was not going up against the US dollar, and it was certainly not going up against a basket of other currencies. So this is what I'm talking about, where you can make your stock market go up anytime you want, but you can't. Central banks are very evil entities, in my opinion. They can print more money, but they can't create real economic value. All they can do is create these sort of mirages. So the stock market went up there, but if you're owning the stock market, your purchasing power, especially your international purchasing power as a Japanese citizen, went down. And this caused various things. It caused a recession in real estate, in Hawaiian real estate prices. I remember looking at Hawaii real estate as the yen had been weakening so much against the dollar. And so you had the stock market going up in Japan, but their currency weakening. So they're it's like a person running in place. They're not really getting anywhere. Now, this is true for all equity indices. I've done previous videos about this, how the S&P has never really recovered from its 2000 high in gold terms. Here's the Nikkei expressed in gold terms. It also peaked around the same time as the S&P 500, and the Dow peaked in gold terms. And it's been straight down. We can see that there has been sort of a bounce since the beginning of Abenomics. So there's a similar strengthening of the Nikkei against gold, but it hasn't been that dramatic, and that's simply because their stock market's going up, but they're weakening the currency. Now, there are a number of reasons that people give for Japanification. One of them is obviously the aging population. This is a statistic a lot of people like to throw around, that Japan's now spending more on adult diapers, elderly person diapers, than baby diapers. They have one of the oldest populations in the world. A lot of people over the age of 65 not being supported by as many workers. And so there's the theory that you have fewer workers versus retired people. The retired people are very thrifty. They don't spend a lot. You don't have a lot of young workers spending a lot. You have young couples are not really having babies in Japan. And they also have a fairly closed system. There's very, very little immigration to Japan. The U.S. also has slowing demographics, but we have a lot of immigration that works the other way. Another thing that people often cite is that Japanese companies, so companies that make up the Nikkei 225, they behave very conservatively. They hold a lot of cash on their balance sheets. So a huge percentage of the market cap of the average Japanese company is just cash. Now, where's that cash sitting? It's sitting in Japanese banks, earning 0%. And so this is a little bit like this current situation with Warren Buffett's Berkshire Hathaway. Something like a third of Berkshire right now is in cash. And of course, it's a good option for Buffett. He might get aggressive at some point. It's sort of the optionality of cash. But Japanese companies tend to be very, I don't know if there are cultural reasons for this or just the history of a very difficult few decades. But Japanese companies sit on a lot of cash. And when a large percentage of your market cap is in cash, and that cash is earning 0% or negative percentage, it's hard for equities to rally a lot. Now, I would contrast this with the U.S., where we have a lot of distribution of cash back to shareholders, or certainly back to executives in the form of stock buybacks that prop up a stock's price and enable the executives to cash out of their stock options without diluting the company too much. And so we have kind of the opposite problem here, where companies did not hold enough cash, and now companies like Boeing and the airlines are in trouble. They spend all their cash on buybacks. So this is sort of the two extremes, where you have too large of a rainy day fund perhaps in Japan, and much too small of a rainy day fund in the US. But while you're doing all those buybacks, as was happening really from 2015 to 2019 in the US, share prices go up quite a bit. Then there's the cultural differences. These are sort of stereotypes, but I think they're true. America, the U.S. tends to have more of a Wild West mentality, especially the West Coast. You have Silicon Valley, obviously. You have all these new innovative companies that are also, unfortunately, quite monopolistic, the Facebooks and Googles and Apples and Amazons of the world. But I would say that there is a sort of entrepreneurialism that is built into the American psyche that you don't have in Japan as much. You don't have the same number of startups, or that same sort of startup culture, or that innovation. And if you're a Japanese citizen and you're really interested in doing startups, what do? You pack up your bags and you come to Silicon Valley. And so I think this would be another cultural difference, where Japanese companies tend to be a little more conservative, more hierarchical, and definitely more fiscally conservative. So those are some differences. Obviously, a lot of stock market returns in the U.S. over the last 5 years have been driven by the FANG stocks. So this may be an important business. You obviously have big tech companies in Japan as well. Sony's a good example. And of course, you have SoftBank, which has just been a terribly run company, and they've really blown themselves up with WeWork, etc. So those are some sort of cultural differences. Another thing I would say is that when Japan peaked, we talked already about how the land under the Imperial Palace was worth more than all of California. So that shows you that there's a huge mispricing of assets. A similar thing happened with the Nikkei. So near the peak of the Nikkei, PEs were trading. These are 12-month trailing PEs. The PE of the Nikkei was between 60 and 70, which is an extremely high PE for a stock market. We got something similar in the late 99, early 2000, where Coke was trading for 40 times earnings. A lot of the big blue chips, GE, etc. You can see these big spikes in the PE. These are simply during bear markets when earnings fall. So you don't want to look at these spikes, but you want to kind of look at where the PEs were before things crashed. PEs were quite high. I would say that they were closer to about 40 for the big blue chip companies that everyone liked. But this is nowhere near the peak that you got in Japan of around 60 or 70. And so when you buy stocks at a really, really high PE, if the growth is not there, obviously you could buy Facebook at a very high PE. There was a lot of earnings growth. The PE came down because the earnings went up. But you never had that sort of growth in Japan for whatever reason, for cultural reasons or anything like that. And so that's one reason the Nikkei has never been able to get back to these really high levels, simply because it was trading at such a high PE. It was pulling forward all of the future growth and discounting it. And so it's really been treading water, trying to digest that ever since that. So right now, the PE on the S&P 500, the trailing PE, call it 22, 23. We can argue about whether earnings are ever going to come back after the COVID crisis, but a much more conservative PE compared to where the Nikkei peaked. finally, I would, and I think this is really where the answer is, why we're in no danger of Japanification in the U.S., simply because the U.S. dollar is the world reserve currency. And so this is a blessing and a curse. It turns out to be a curse in the long term. In the short term, it's a blessing. So for example, the U.S. can print dollars and buy crude oil with it. The U.S. can print dollars and buy anything in the world it wants, as long as people still accept the dollar. Whereas other countries, if they want crude oil, they either have to dig it up themselves, pump it out of the ground themselves, or do something productive, exchange that productivity, those products and services for dollars, and then buy crude oil. Japan did not have the luxury. Obviously, the yen was never a world reserve currency. Even though the Japanese economy is quite large, doesn't have the global reach of the U.S. economy and U.S. culture. As a result, Japan had a problem. If they wanted to print a lot of money to drive up their stock market in nominal terms, so basically printing money, buying stocks with it, buying bonds, etc., because they were not printing the world reserve currency, they were not printing US dollars, but they were printing yen, as they drove down the value of their yen, they could depreciate the yen as much as they wanted. They could print a quadrillion, zillion dollars. But in the process, they would drive up commodity prices. They would drive up oil prices. And Japan, as you can imagine, it's a series of islands. They have to import a lot of stuff, particularly energy products, crude oil, iron ore are the big ones, and then food products. So here's an old article from 2016 actually, citing 2013 numbers that says, and I assume these numbers are roughly the same now, I couldn't find more up-to-date numbers, Japan imports about 60% of its food each year. There's not a lot of land, obviously. There's small islands, and they import a lot of meat as well. That's the largest component. 20% of their food imports are meat. So what happens if they let's say they want to drive up the Nikkei? They can print a lot of money. They can certainly drive up the Nikkei, but in the process, crude oil is going to become very, very expensive for them. Food is going to become very expensive for them, and this will not be good for the overall economy. It can make the stock market go up, but if all of a sudden gas prices, commodity input prices go way up, you're going to have a big problem. The U.S. doesn't have this problem, at least in the short term. It certainly has a problem in the long term because we run trade deficits and current account deficits, and we have a negative net investment position. But we do have the world reserve currency, and that's why I think we will be able to print money and get the stock markets back up to new highs. I'm not saying we're not going to have a rough summer here where stocks fall, but I think we'll have nothing like, there will be no Japanification. The U.S. Is a net debtor nation, and as a result, it makes a lot more sense for us to inflate our way out of this. And we don't have to worry about the same, eventually we'll lose control of energy prices and commodity prices, and this is already what's been beginning to get priced into the Bitcoin market and the gold market. But we can sort of print our way to new highs in the equity market in a way that Japan could not do. So I think that's the chief difference and why we're not going to see Japanification in the U.S. We may see very low interest rates, but we, as part of that, and as part of all the quantitative easing, the money printing, we're going to see much higher stock prices, much higher real estate prices. And again, these are going to be nominal gains. Your purchasing power is not going to go up. If you own the S&P 500, and let's say it takes a certain number of shares to buy a car now, the price is going to go up for the S&P. It's going to hit all new time highs, but you're still, you're not going to be able to buy, exchange those S&P shares for a nicer car, a more expensive car. In fact, it'll probably go the other direction. If you found this helpful, you should check out my online courses. I have a bunch of courses that can teach you how to make money in a sideways market, in an inflationary market, in a deflationary market. I'd especially encourage you to check out my Bitcoin course, bear market trading strategies, learn to trade stocks like a pro. And also if you want to learn how to make money with options and futures, as well as I've got a segment on real estate investing, fixed income investing, etc. So if you've been stuck at home, if you're still stuck at home and you're tired of binging on Netflix, you can watch all my free videos on YouTube, check out my Amazon books, and then if you really want to go deeper, check out my online courses. I'll stick a link in the description notes below, and you can just click on that. You can click on any of these courses to see the list of lectures inside of each course. And then if you're interested, click on the Get It Now button, which will take you to this checkout page. Now, normally access to all these courses, you get access for 30 days to all 13 courses. No long-term contracts or anything like that. Normally that access, the tuition is $125. But because we're in a recession, I'm going to give you a coupon code, and it's going to be YT, as in YouTube, 99. Click Update, and that'll take $26 off. So it'll just be $99 for 30 days access. You can watch all the courses, take notes on them, and then cancel before 30 days is up, and you won't be charged again. Again, this is there are no long-term contracts or anything like that. And if there's something missing and you'd like me to add a course or add lectures, you can let me know as a subscriber, and I'll record a course just for you, share it with everyone, and in that way, I hope to make this the best resource for learning about how the economy really works and how the financial markets really work, so you can prepare for yourself and for your family for a good financial future. If you found this video helpful, please hit the subscribe and like button, and let me know your questions and comments, as well as suggestions for future videos in the comment section below. Thanks a lot for listening, and I'll see you in the next video.